Hello, this is Jordan, and this video is being recorded on Tuesday, October 26th, 2021. Thank you so much for joining me. Please like, comment, and subscribe. And in this video, I am going to provide a brief technical outlook on gold as it closes October and enters November. And, gold's had a bit of a rally. The gold stocks have had a good rebound. They were extremely oversold, and we're starting to see the gold bulls get really excited again. And I just want to caution people that it's too soon to get excited, and I'll explain why. And I only have two charts. The first thing with this gold chart, this is a daily line chart, and we're starting to see, I'm starting to see, and I'm not singling out any person in particular because I've seen this from 10 different people, I think. We're starting to see that forced triangle on the gold chart again, where I kind of draw it there in real, it's real light there. But I did a video, I think it was back in the summer, about triangles and how to draw trend lines and how you really need to. The main takeaways from that are, for trend lines to be significant, you need a minimum of 3 or 4 points, because any trend line can be 2 points, basically. It starts off being 2 points. So you really need, in my opinion, 4 points for a trend line to be significant. And the other thing about triangles is they are continuation patterns for the most part. And so that means they tend to continue. They're a consolidation or a correction, but they tend to be, they tend to follow the trend. So if they occur after a big move up, they tend to continue that trend, and eventually you'll get a breakout to the upside. In a downtrend, you see a triangle, that's going to continue the downtrend. It's going to break lower again. And so what we're seeing with this forced triangle on gold is, what I meant to say is what we're seeing with this triangle on gold, or on the gold chart, is a forced triangle. If you look at the bottom there with the check mark and the X, the check mark, that's a triangle. The X, that's not a triangle, where you're trying to force the market into some kind of triangle that it isn't in. And so with respect to gold, it's not in a triangle because it's not connecting 3 or 4 points on the top. And the issue with if it were to be in a triangle, the issue with the resistance is during the triangle, the highs, the highs within that triangle, they tend to be closer to where the triangle started. So if you look at the check mark in the example, you can see that the rallies within the triangle, they tend to peak at levels that are close to the previous peak. So in other words, if gold were in a triangle, the high is close to 2100 where it started, and you're seeing these peaks that are, in the 1900s, 1900. They're lower, and so they're not even close to 2100. So we're not. The gold is not in a triangle or some kind of consolidation triangle pattern. I'm sorry to belabor the point, but the real key for gold, if we're looking at levels, it's clearly that around 1830, 1835, I drew it there in the thick red line, the horizontal line. And, the moving averages, the 200-day, the 400-day, those are my favorite long-term moving averages. They come into play at 1795, 1817. So then you have the thick red line around 1830, 1835. That is the key level for gold right now. All the triangle trend line stuff, just ignore that. It's 1830, 1835. And so for gold to really get into a bullish, a bullish outlook, what you would need to see happen is gold, it breaks above all that resistance, trades up to 1900, and then it consolidates and corrects. And, you have the moving averages of the 1830, 1830, that becomes support. And so, of course, some people might say, well, that's obvious. Gold broke above a level. It's obvious it's going to be bullish at that point. But that's my point. That has to happen before we can say with some confidence and with probability that the outlook is bullish. Gold, it's still on a downtrend. It hasn't come close to I mean, it's struggling at 1,800 now. So there's nothing at the moment that tells you that it's going to break above 1830, 1835 and do what I just suggested. And so that's why, for the outlook to be bullish, that's what needs to happen. That can put all the naysayers, myself included, to bed with that kind of a move. When you see gold get to 1,900, corrects and consolidates, that's the look of a market that's correcting, consolidating before it's going to, make an attempt to break through real resistance. And the other thing to look at is you also have to look at weekly and monthly charts. And if we look at the monthly chart, you can see the key levels are obvious. You have, let's see, 1,900. You have that level. Look at the monthly chart. Gold, after it peaked, it failed at 1,900 multiple times. And, more recently, that, 1820, 1830 level, I mean, that's significant going back to 2011. When gold peaked, you can see that the monthly closing high in 2011, I think, was 1820, 1825. So, I mean, that's close enough to 1830, 1835. I mean, I guess the monthly resistance is around 1820, 1825, and gold is still below that. And so if gold were to close above, make a monthly close above 1820, 1825, the assumption is it'd probably make a weekly or daily close above 1835. Then it's in position where we know it's going to rally to 1900. But still, at that point, there's a lot of work that has to be done. So, you can look at the daily chart and think, well, this is looking more bullish. This is setting up. That's great. But this is called technical analysis on multiple time frames. You have to see how it's performing also on the weekly and the monthly. And so we're coming up to the end of the month here. And so as bulls, what we'd really want to see in the next couple of days is gold explode above, close the week above 1820, 1825, that resistance. That would be encouraging and tell us that the market has changed. Before I go, one other, bearish negative aspect, which I didn't put in here, is gold is not showing a positive divergence against foreign currencies. So a lot of this recent rebound has just been dollar weakness. We aren't seeing that much more strength against foreign currencies in a short-term context. And the second thing is also gold against the stock market. I mean, the stock market is at a new all-time high, or it's very close. I mean, the advanced decline line in the S&P is at a new all-time high. So when we look at all those factors, I am not seeing reason to get super excited about the market yet. I just think it's premature. Now, the positive thing is history tells us gold is likely to rally significantly when the Fed makes that first rate hike. So even if gold were to weaken, not break out, sell off, maybe it tests 1675 again, maybe it has a false breakdown to 1600 or whatever, that happens before the rate hike. To me, it's really meaningless. It's just giving a better entry point, because the history behind the rate hike and the way the market is setting up, that is going to be a bullish catalyst for gold. And we'll talk more about that in the weeks and months ahead. But it's not imminent. So we have to keep that in mind. Let me know what you think in the comments. Thank you for listening to the video. And I look forward to doing another update for you guys in the days and weeks ahead. Follow me on YouTube and go to TheDailyGold.com. You can subscribe there. Thank you.